The Bank of England just said the quiet part out loud. Governor Andrew Bailey told the world a regulatory showdown is coming with the United States, and the battlefield is stablecoins. His argument is simple, yet dangerous. Weak American rules around dollar coin redemptions could export run risk straight into the British financial system. One US stablecoin failure, one bad redemption window, and London absorbs the panic. That is the official position, but underneath the central banker language is something far bigger. Because this isn't really about consumer protection, it's about the United Kingdom watching American dollar stablecoins quietly take over the global digital economy and deciding it's time to fight back. First, Europe moved against Tether through MiCA, now the UK is opening a second front, and the United States is doubling down on dollar dominance with the Genius Act. Stablecoins have officially become geopolitical weapons. So in this video, I'm breaking down what Bailey actually said, why the UK is moving now, how this fits into the global stablecoin war, and what it means for your portfolio. I'm DC and you're watching The Coin Bureau. On May 8th, at a Bank of England conference on financial imbalances, Andrew Bailey did something central bank governors almost never do. He named the United States as the source of a coming systemic risk. His exact words, and I quote, "If we want stablecoins to be part of the architecture of payments globally, they're only going to work if we have international standards. Frankly, that, I think, is going to be a coming wrestle with the US administration." Wrestle. Now, that is not diplomatic language. That is a man who chairs the Financial Stability Board, the global body responsible for international financial regulation, telling everyone listening that he expects active institutional conflict with Washington. But then he went even further. He said, and I quote again, "We know what would happen if there was a run on a stablecoin. They'd all turn up here." So in other words, London absorbs the wreckage of American failure. That is the headline, but the mechanics underneath it are where things get serious. So let's decode the run risk argument, because this is where central bankers speak meets actual crypto reality. Here's the technical pressure point. Under the Genius Act signed by Trump in July 2025, US stablecoin issuers are permitted a 7-day redemption window during periods of market stress. 7 days. Under the proposed UK regime, redemption is on demand, 1-to-1, end of business day. And that gap is everything. Because if a major US stablecoin hits a confidence crisis, holders cannot necessarily turn their tokens directly into dollars. They have to route through a crypto exchange, and if that exchange is under stress, frozen, or has its own liquidity problems, that conversion mechanism breaks entirely. So Bailey's nightmare scenario is the cascade. A US stablecoin slows redemptions, panicked holders dump on secondary markets, liquidity seizes across exchanges and DeFi, the capital floods toward UK-regulated assets, which absorb the panic with no US backstop. And Bailey's not simply making this up out of nowhere. In March 2023, USDC briefly depegged to 87 cents when Silicon Valley Bank collapsed. That is the live precedent. Now imagine that event with a stablecoin market that has grown from roughly 130 billion then to over 322 billion today. That is the real risk Bailey's pointing at. Look, this stablecoin war is going to move fast, and most of it will play out in treasury consultations, central bank papers, and quiet rulemaking that never makes the headlines. If you want our team's read on every catalyst before it hits the market, the Coin Bureau newsletter goes out every week with the deep dives, regulatory tracking, and macro signals we can't fit into a YouTube video. It's free, the link is in the description, it's genuinely worth it. Get on the list. Now, to the timing question. Most people might be wondering, why is Bailey speaking now and not 18 months ago? There are 3 major reasons for that. First, the Genius Act is law, not a proposal. So Bailey is responding to an enacted American framework that codifies the very redemption gap he's worried about. Second, MiCA in Europe has already proven that Western regulators can squeeze dollar stablecoins through coordinated rule sets. The UK saw it work, and they're naturally following. Third, the UK's own authorization gateway opens in September 2026. So Bailey is stake planting before the architecture gets locked in. But there's also an internal tension here that you need to see clearly. Post-Brexit, the British Treasury wants London to be a global crypto hub. Chancellor Rachel Reeves keeps repeating that bringing crypto into the regulated parameter is, quote, a crucial step in securing the UK's position as a world-leading financial centre. That is the competitive instinct. But Bailey and the Bank of England are pulling the opposite direction. They want monetary sovereignty. They want sterling on the rails of digital money, not the dollar. And right now, sovereignty is winning the internal fight. Which brings us to what this actually is about, because the run risk argument is real, but it's also the cover story. The actual real war is over who controls the rails of digital money. And for that, we just have to look at the numbers. Global stablecoin market cap 322 billion. The dollar-denominated share is between 98 and 99%. USDT alone is around 190 billion. Tether currently holds about 140 billion in US treasuries. That makes Tether the 17th largest holder of US government debt on the planet. That's larger than most sovereign nations, and every new dollar stablecoin issued forces the issuer to buy more T-bills, which means every USDT and every USDC in circulation is a private sector automated permanent bid for US sovereign debt. And that is not a payment product, that is monetary policy in token form. Now let's flip that perspective. Every dollar stablecoin transaction that settles cross-border is a transaction that didn't run through SWIFT, didn't touch sterling, and didn't pass through a London clearing bank. Stablecoin transfer volume hit 4.5 trillion in Q1 2026 alone. To put that into perspective, the annual volume rivals Visa. Every one of these settlements is a vote against the pound's relevance in the next financial system. So Bailey is not protecting consumers, he's defending the City of London's seat at the table. And most importantly, he's not doing it alone. If we look at the pattern across Western non-dollar economies, a highly coordinated picture emerges. In Europe, MiCA effectively pushed Tether out of the EU-compliant exchanges. ECB President Christine Lagarde, on the same day Bailey spoke, said this, and I quote, "If we want to strengthen the international appeal of the euro, stablecoins are not an efficient way of doing so." She has called the dollar stablecoins a Trojan horse for digital dollarization. And 12 major European banks, including BNP Paribas, ING, UniCredit and BBVA, just formed a consortium called Quivilis to launch a MiCA-compliant euro stablecoin in late 2026. The French finance minister explicitly said the goal is to end US dominance in digital payments. Canada also launched CADD this month, which is the first regulated Canadian dollar stablecoin framed openly as a defense of monetary sovereignty. And now the UK opens its own front. So this is not a coincidence. This is the entire West finally realizing that if dollar stablecoins become the default settlement layer for global digital commerce, every other currency loses relevance permanently. And of course, Washington is responding hard.
The Genius Act, they named it after me, and I want to thank you.
The Genius Act isn't just a regulatory framework, it is a deliberate national strategy. Treasury Secretary Scott Bessent could not have said it any more clearly. In his words, and I quote, "We are going to keep the US the dominant reserve currency in the world, and we will use stablecoins to do that." Bessent has projected that the stablecoin market will reach 3 trillion within the next 4 years. He has explicitly stated stablecoins will be factored into long-term US debt management. So in simple terms, the United States is building a private sector mechanism to permanently absorb its own treasury issuance through token demand. Which is exactly why Trump called the Genius Act a giant step to cement American dominance of global finance. Why the House Financial Services chairman said stablecoins extend the reserve currency status of the dollar, and why Kevin Warsh, the new Fed chair as of May 15th, openly supports private stablecoins over a US CBDC and has called Chinese e-yuan a direct threat to dollar dominance. This is coordinated American policy, the dollar's digital extension into every smartphone, every emerging market, every cross-border settlement that used to require correspondent banks. Allies pushing back is exactly what accelerates that response. And caught in the middle is none other than Tether and Circle. Tether is exposed on every single front. It dominates offshore liquidity but faces multi-jurisdictional pressure from MiCA, the UK regime and emerging non-dollar competitors. And its response has been clever. It launched USAT, a US-regulated stablecoin issued through Anchorage Digital Bank, fully Genius Act compliant. That keeps USDT as the offshore liquidity layer, while USAT plays inside US rules. And Tether has aggressively positioned itself as a sanctions enforcement tool. In April 2026, Operation Economic Fury froze $344 million in USDT linked to the Iranian Central Bank and the IRGC. Over $4.2 billion frozen across 3 years. CEO Paulo Arduino said it bluntly, and I quote, "Now wars are financial wars." Now Circle has taken the entirely opposite path. Pure regulatory positioning as the institutional standard. And USDC market cap has grown 28% year over year, sitting at around $78 billion to the time I record this video. And of course, it's backed by a SEC-registered money market fund managed by BlackRock. If compliance demands fragment the market, Circle benefits. Tether bleeds offshore margin while compliant alternatives capture the institutional flow. But here's the bigger picture, because this really isn't about Tether or Circle. This is about dollar stablecoins as the new front in the currency war that started with sanctions on Russia. Look at what's happening in parallel. mBridge, the BRICS payment system using digital yuan and other CBDCs, has processed over 55 billion in cumulative transactions. China's CIPS handled 24 trillion in 2024, up 43% year over year. The BRICS unit, a gold and basket-backed digital settlement tool, launched a pilot in October 2025. And India is pushing CBDC linkages between BRICS members for 2026. And all of this while the dollar's share of global reserves just hit a 30-year low at around 57%. So every major economy is now forced to take a side. Stablecoin neutrality is officially over. So what does this actually mean for crypto, and how should we position ourselves around it? There are a few things we need to track. First, if UK pressure compounds with EU pressure, we have to expect compliance fragmentation. USDT liquidity gets pushed further offshore, while USDC and emerging regional issuers absorb the regulated flow. Then we have to watch for the rise of sterling, euro, and Canadian dollar stablecoins as serious products, not novelties. And of course, we have to watch the catalysts. UK Treasury consultations, Bank of England papers in June, the Clarity Act Senate markup on May 14th, OCC rulemaking on permitted payment stablecoin issuers, and we have to wait for the next central bank to follow Bailey's lead. Because there will be one. This isn't a regulatory disagreement, it is the second front of a war over who controls the future of money. The European Central Bank moved first against Tether, the Bank of England just opened a new battlefield against the dollar itself, and the United States is responding by doubling down on stablecoin dominance through the Genius Act. So crypto is clearly no longer the small experiment corner of finance the regulators used to ignore. It is now the terrain on which the most important currency war of the next decade will be fought. Expect more central banks to follow Bailey's lead, expect more pressure on US stablecoin issuers operating across borders, and expect the line between crypto policy and geopolitics to disappear entirely. The question isn't whether this conflict reshapes the stablecoin market, it's how fast and which version of digital money the next generation of users actually ends up holding. If you got value from this, please leave a like, it genuinely helps the channel. And if you want to understand exactly how the European Central Bank is fighting Tether, then you should definitely check out our deep dive right over here. Thank you all so much for watching, and I'll see you again very soon. This is DC, signing off.